Are you ready to make the most of your oil and gas mineral rights? Welcome to the Mineral Rights Podcast. Get the knowledge and resources you need to manage your minerals and royalties. Here is your host, Matt Sands.
Welcome to the Mineral Rights Podcast. I'm your host, Matt Sands, and I'm here to help you make the most of your mineral rights and royalties. On today's episode, Justin Williams and I speak with Will Cullen, who's the Vice President at Longpoint Minerals. Will and I go back several years to when we both worked for Shell in different roles supporting their Pinedale Anticline asset in Wyoming. He has an extensive background in finance, economics, and business development in oil and gas and minerals specifically, which we talk about today. You won't want to miss this episode because the conversation covers a ton of insightful information as to how a large mineral buyer operates and approaches mineral acquisitions and the current state of the minerals market. We also talk about some really useful tips to help mineral owners get the most when leasing or selling their minerals. So be sure to check out the show notes at mineralrightspodcast.com to download a free mineral rights valuation resource guide that I put together that goes into some of the topics that we discuss. So let me tell you a little bit about Will Cullen. Prior to joining Longpoint, he served in various capacities for Shell, beginning in 2007 as a development economist, followed by a placement into Shell's A&D group as manager of M&A and commercial finance. In 2015, Cullen was appointed MLP Business Analyst Lead. Before his career with Shell, he owned and operated Highland Minerals and Royalties and was in institutional sales with Petrie Parkman. He joined the 4 Point Energy team in 2016 as the Vice President of Business Development and immediately helped the team launch Longpoint Minerals and Longpoint Minerals 2. Since 2016, Longpoint has closed over 1,200 transactions and acquired over 127,000 net royalty acres in Oklahoma and Texas. Will holds a Bachelor of Fine Arts from Montana State University, an MBA, and an MS in Finance from the University of Denver. Before we get to my conversation with Will, I have a quick reminder. As always, please subscribe to the show on iTunes or wherever you get your podcasts and leave us a comment there in the form of an honest rating and review to let us know what you think. To ask us a question to be featured on an upcoming episode, you can go to mineralrightspodcast.com and leave a comment in the show notes, or you can send an email to feedback@mineralrightspodcast.com. So without further ado, let's get into the conversation with Will Cullen. All right, welcome, Will, to the Mineral Rights Podcast. Thank you so much for coming on the show.
Yeah, thanks, Matt. Really appreciate you having me.
So let's get started with a question that we ask all of our guests. How did you get started in the oil and gas and mineral rights business?
So it's kind of interesting the way that I got started in oil and gas and in minerals, not your typical path. My background actually is fine art. That's what I went to school for and did graphic design after I got my bachelor's degree for a little bit, and then decided to go back to business school. And my original plan was to go take marketing classes and get a master's in marketing and pair that up with my fine art degree and get into advertising. But as I was going to business school, they make you take introductory classes, and one of those was finance. And I fell in love with finance, and so switched over to finance and immediately dropped all of my marketing classes. And while I was going to school, I also had this great opportunity to go work for a small oil and gas shop, actually local there in Denver, called Helm Energy. And what was really great about it was there was only about 8 people in the office, but it was really a good place to learn about the industry because I could go ask anybody any question about what was going on. And so, I could ask the geologist, the president, the accountant. It really gave me a good bottoms up look at oil and gas. And I started out on the land side, looking really just at contracts, and would spend most of my days looking at contracts. From there, when I graduated from business school, I got a job with Petrie Parkman, which is a boutique investment bank, which also had an office there in Denver. And I did that really until about 2006. And then Petrie ended up selling to Merrill Lynch. And I decided not to go with Merrill Lynch. And a friend of mine who was also at Petrie at the time was going to get into the mineral space, and he was going to work for a company called MAP, Mineral Acquisition Partners. And he introduced me to a local geologist there in Denver, Sig Rosenfeld. And Sig and I partnered up together and would go out and try to find minerals, and then look for somebody to sell them to. Sometimes we'd sell them to MAP, sometimes we'd sell them to other companies. But the business was really quite different at that time. In a lot of cases, you ended up just being a consultant, really, and helping folks understand what they owned. And then in the instances where people were interested in selling or they did want to sell, it was really up to you then to try to go out and find a buyer. And there weren't a lot of folks out buying these at that time. And so quite a different landscape and world than we live in today. I did that for a couple of years and then went to go work at Shell. And that's where you and I met. And I worked at Shell for about 9 years. And then after about 9 years, I was approached to come work at Longpoint, and that brought me back into minerals specific. But I've always been in oil and gas since the early 2000s, but it's in the last almost 4 years now that I've really come back to just being minerals specific and minerals focused.
Very cool. It's been an up and down time period because I started in the industry about the same time, and so we've definitely seen ups and downs over that period. What kind of interested you about moving over to Longpoint? Tell me a little bit about Longpoint Minerals and how did the company get started?
Yeah, so the way that Longpoint got started actually was an idea formed back when my current CEO, George Solich, had his company Cordillera. And at the end of Cordillera, before they sold, they were in a massive leasing program. And while they were leasing, what they found were that some people would say, hey, instead of leasing me, what would it take for you to just buy me out? And there was this interest that they noticed from people, not just in leasing their minerals, but possibly selling these minerals. And the light bulb sort of went off, and the guys realized, hey, there might be a market out here for folks that want to buy and sell mineral interests. And so then when they formed their next company, which is 4 Point Energy, that's our sister company. It's your traditional E&P company that goes out and drills wells. When they formed that company, they said, let's go ahead and put in our charter that we also want to go do a mineral company. But it took them a little while to get that going. When they first started, they were just focused on the traditional E&P side of the business, drilling wells, producing oil and gas. It wasn't until 2016 that they were able to partner up with Canadian Pension Plan Investment Board, who provided the bulk of the funding, to really go out then and launch a minerals specific and a minerals only company that was just strictly focused on buying mineral interest. And that's when I came on board. So in 2016, they approached me. They knew that I had had a mineral company kind of in a prior life. They knew my track record at Shell and asked me to come on board and help them get this thing off the ground and run it and just see what we could do. And we've been doing that ever since.
Very interesting. And can you talk a little bit about the strategy of Longpoint?
Yeah, definitely. I think our strategy differs from several other mineral companies out there in that our capital that we have partnered with is really long-term, long-dated capital. And we are an end user of the minerals. So when we buy it, our intent is to buy those minerals and hold on to them. We're not in the business of trying to buy minerals from one party and quickly turn them over and flip and sell them to another party. So we're an end user. We're a long-term holder. We believe in the space. We believe in owning these things and holding them for a long time. And we really are really drawn to the yield that these potentially provide our investors. In terms of our strategy, one of our focuses has always been to be where the rigs are. And so we are right now a 2-basin focused company. We are focused in the Eastern Anadarko Basin, and we're focused in the Permian, looking at both the Delaware and the Midland Basins in Texas. We're looking at potentially expanding to the Eagle Ford Basin as another one to add into where we're out actively buying. But we want to make sure that we have some visibility and can understand where operators are going to be, what the drilling patterns look like, what the spacing assumptions, those kinds of things, so that we can offer really robust values and try to capture those minerals and bring them into the portfolio.
Okay. Is there a particular type of seller that you work with, or is it just across the board?
Yeah, I mean, it's across the board. We work with a lot of landowners. We work with also brokers and professionals that are out there, packaging these things up. We stay out of auctions. We just find that it's not really where we can add value. We really value ourselves on relationships. We like to build relationships. We like to work on a one-on-one basis. We're very transparent in our offers. We share our assumptions, share our approach with those people that we do work with when we make them an offer. We really want there to be an understanding. We really strive for a win-win situation. And I think in a lot of cases, when somebody's thinking about selling their minerals, it's an emotional decision. A lot of folks haven't, gone out and bought these things with the idea that they're going to go sell them to somebody else. I mean, unless you're a broker and that's your business, the more common way is that this has been handed down to somebody through, a family member. And, they may or may not still have the surface associated with it. I think the emotional tie is probably even stronger if the surface is still there. But even if this minerals have been severed from the surface and the family no longer occupies the surface, and the minerals are kind of a separate deal, there's still a strong tie there, and we recognize that. And so that's why we really do sort of focus in on the relationship side. I mean, a lot of times when folks are interested in selling, what we'll tell people is, look, just sell us half. And, that allows you to take some chips off the table, put some money in your pocket, but at the same time lets you retain something in case there is some upside. Also, if there's a tie there, that these were owned by, a family member, and you want to keep that for those reasons, that's usually a good solution for folks.
That's always a nice split if you want to diversify and take that lump sum of cash now, but then still participate in any upside. That's a very common thing I find a lot of the clients that I work with as well. You mentioned that Longpoint was in it for the long haul, and you guys are end users of minerals. Other than that, potentially, because there's a lot of other large mineral companies out there, but what makes Longpoint different?
Yeah, I think one of the things is that we treat the mineral business like the E&P business. And I think that's another thing that really makes us unique because we do have our sister company, 4Point Energy. We're able to harness that entire tool set from our operated side into our minerals efforts. And so that means we have a suite of engineers, geologists that are able to go in, look at somebody's position and really treat it and put on the operator hat and say, okay, how is an operator going to come in and develop this? And what is that approach going to look like? And I think it's that unique understanding of really coming from an operator's perspective that does differentiate us and does make us, quite a bit different in the industry. There might be one or two other companies where there's an operated company associated with a mineral company. But even in those instances, I'm not sure that those companies are able to really harness the full power of the E&P company like we are. I think that does make a big difference.
Yeah, that makes sense. You have people that are already experts in those areas, and they can very quickly come to a decision based on that. So that sounds like a really nice synergy. Tell me a little bit about the portfolio that you guys have, and what does it look like today versus when you guys started?
Yeah, so when we started, we really started from ground zero. We didn't have anything. It's not like there was a legacy mineral portfolio that we built on top of or that we inherited and then decided to grow. So we really started from ground zero. We didn't have any minerals in the portfolio at all, and really launched and hit the ground with this idea that we wanted to work with local groups. Like I said, really focusing in on relationships and really go into those basins with that operator hat on, that approach, and say, okay, if we're going to go in and value these things, we're going to go in and talk to these people, be in these communities. Let's really embrace that. And so we've done that. And so we knew right from the beginning, we didn't want to be one of those companies that owned in 20 different states across the U.S. That just owned small fractional interest here or there. We just didn't think that was the right way to go about it. again, that really gets away from this whole idea that we have about being a part of the community, being good partners. And so that's really been, part of our focus has been let's stay local. So in that effort, when we looked at the entire US map, and this, remember 2016, we were just really some pretty dark times in the oil and gas business in terms of price and activity levels. But what that provided was a de-risking, if you will, of all of the plays across the US, because that downturn really pointed out which plays worked and which ones didn't. And as we looked across that landscape, we said to ourselves, okay, there's probably 5 or 6 basins that still work in a low price environment. But out of those 5 or 6, there's still other elements you have to look for that really make it attractive to go in and make mineral and royalty acquisitions. And that's the land picture. So, you have to make sure that there's enough private ownership so you can go in and make offers to private owners. That's what makes buying minerals in states where there's large federal packages of land pretty tough. Thinking about states like Wyoming, where so much of the land there is federal, where there's oil and gas, you can't go buy those mineral rights. So it has to be states or areas where there's enough private ownership that makes that attractive. And then the regulatory environment is also very key, right? You need to make sure, okay, not only is the basin attractive for the operator, not only does the land picture look good in terms of having enough private ownership, but also you want to make sure that the regulatory environment is friendly to operators and that that's not going to be a hindrance to operators bringing in activity and drilling up those minerals. So those are the components we really looked for. And when we did that, it really came down to just a couple of basins that checked all of those boxes. And so that was the Eastern Anadarko Basin and the Permian Basin. And that's where we focused. Certainly the industry has changed from 2016 to now. It's still not real great in terms of price, and you're not seeing rigs everywhere. But that is one of the things now that's causing us to take a look outside and say, okay, can we now expand to other areas? And that's where, the Eagle Ford really has kind of come onto the radar screen for us and taking a hard look there, because we think it does check a lot of those boxes that I just mentioned that become pretty attractive as an area for us to go into and make acquisitions.
Yeah, I agree with the regulatory comment. I know that certainly here in Colorado, where Longpoint is headquartered, and where I am as well, we're facing a lot of political headwinds, let's call it, at the state level with recent state regulations that were passed. We've talked about on the show several times, but does help with not having to deal with that element of risk, because certainly, like you mentioned, you want to be where the rigs are because you aren't in control over when the well is going to be drilled. And so trying to take that out of the equation makes a lot of sense.
And I think that, the Colorado story really is one that's too bad. I mean, as you mentioned, we are headquartered in Denver, large part of our company. In fact, my CEO was born and raised in Colorado. So we have a lot of Coloradans here in the office. And we took a really hard look at the DJ Basin. It's right in our backyard. A lot of our folks internally here have expertise in the DJ Basin. And that was one that early on we did want to expand into. And we had everything ready. We did all the technical workup that we would do. We had everything in place, ready to go. And it was the uncertainty around the political environment that made us pause. And then, when we had the election and unfortunately had the administration change at the governor level, that's when we decided to continue to hold off and see how this plays out. So I think, Colorado has always had a really strong history in the oil and gas business. They have really attractive rock. I mean, there's a lot of hydrocarbons here in Colorado. And unfortunately, at this time, there's just a regulatory environment that's pretty challenging and provides a lot of uncertainty in terms of what the future looks like for Colorado's oil and gas. And that's unfortunate. And so we've stayed out of Colorado for that reason. I think if we saw a change there, it would certainly be something that would come back up on our radar screen, and we would love to do more business.
Yeah, that makes perfect sense. Tell me a little bit about the deal flow coming into Longpoint. I imagine the funnel is pretty wide in order to close one deal, but can you tell me kind of How much are you looking at? How many opportunities are you screening in order to close that deal, just on a unit basis?
Yeah, so we've done over 1,000 separate transactions, and that's on over 5,000 tracts of land in our almost 4 years of existence now. We look at probably 2,500 different deals a year, and from that, transact only on a portion of that. Only about 10%, about maybe 250 to 300 a year. And so it's a lot of going through a lot of different opportunities. We have seen a lot of stuff. I think there's been a lot of change in the mineral space that has really brought about why we're seeing so much more deal flow. And I think one of the big things that's tied to has been the shale revolution. Prior to the shale revolution, it was really hard to define how big the resource was, what operators were going to do, what development plans look like. But as technology evolved with horizontal drilling, pad drilling, operators going through a land grab, defining these plays, and really sort of then getting into more of a manufacturing mode where you could have more certainty around what the development was going to look like. You just, before all that happened, you just couldn't offer a lot in terms of value to a mineral owner. Now that you have all of that at your disposal, all of that has transpired and it's really sort of defined things, you can offer a mineral owner more than just a multiple on whatever they're getting from their current check run, which back when I was doing mineral and royalty acquisitions in 2006, 2007, and early 2008, that was really all you could do at that point. You looked and said, okay, I think you have, this much production coming off of your minerals, and I can see the cash flow that you're providing. People would provide a check stub, you could see that. And you would play out some forecast on just those existing wells because you didn't really have any of that certainty around what was going to happen in terms of future development. And so people typically just got a small, low multiple on what they were currently getting on their checks. With all this technology advance, with the shale revolution, that's changed the game for sure. And so now what you see companies like us, and there's other ones out there now too, and it's really changed the way that we approach things. We're able to offer mineral owners not just what they're currently getting, but what we think the future development is going to be, and offer them value on those wells that haven't even been drilled yet. And we spoke earlier a little bit about people taking some chips off the table and only selling half. I think that's a real good case of this because it's almost a way for folks to de-risk a little bit. It puts the risk on us. We're willing to take that risk. We're willing to be extremely patient. Not everybody's willing to do that. I mean, we forecast what we think might happen and we offer people value based on that. But if that doesn't transpire, that mineral owner still got their check from us for their minerals, but now it's just on me, right? It's just on our company if what doesn't transpire, is what we thought was going to happen. And so again, it really comes down to risk, and I think that the values that we're able to place on minerals it's just changed. The numbers have gotten so big, people can no longer ignore the offers that they get from these mineral companies. The numbers have gotten to levels that they just weren't at before. They're at new levels that didn't exist 10 years ago.
So, Will, thank you for being here with us. And if you don't mind, let's talk a bit more about evaluation. It's commonly understood that minerals are worth more if there's a clear line of sight to near-term drilling activity on a given tract of land. But since the mineral owners aren't in control of when the wells are drilled, can you talk about why most mineral companies like yourself focus on buying minerals just ahead of the drill bit, like you mentioned, to be where the rigs are?
Right. Yeah. Well, because when you look at putting that valuation together, you're putting together lots of items. So you have how many wells you think are going to be drilled in total to develop the resource, what the rate will be from those wells, how much those wells will ultimately pull out of the ground in terms of oil and natural gas. You have to have some sort of thought around price. I think typically a lot of people will use the strip pricing. They may have their own internal number. But what we found is the biggest lever out of all those assumptions that go into valuing these minerals is development timing. And so you can have the best rock, you can have, a really great operator, but if that operator doesn't come and drill on that particular part of land for, say, 10 years, the time value of money for that 10-year gap of no activity just really destroys the value and erodes it down to a pretty minimal number. And so that's why a lot of companies will focus in on the near-term indicators, because it gives them some sort of comfort, gives them some sort of at least seeable path where they know, okay, I know I'm not going to get the timing exactly right. Unless I am the operator myself, I don't know if they're going to drill that this year or next year or 5 years from now. But I know if there's permits in place, or I know if they've made some other regulatory filings, or I know if I've seen some drilling pattern and they seem to be following some sort of logic in terms of how they're going across the field, and I can kind of figure out logically where they're going to be next. Those types of things at least allow you to put some bookends, some parameters on what you think that timing is going to be. Without that, you're really making some pretty blind guess, and you may be in the ballpark and you may not, but that's why people focus in on that. It's what gives them comfort. It's what allows them to, like I said, sort of put some parameters around that time.
Absolutely. And would it be safe to say that really it helps to manage your return on investment and to be sure that you are going to have some in the near future?
Yeah, definitely. I mean, that's the biggest thing. I mean, we're backed by Canadian Pension Plan Investment Board, and so they're interested in yield and return. And so for sure, all of our investments, everything that we buy when we're buying minerals has to fit a certain profile in terms of what we think the ultimate return is going to be. Again, we don't have to get it exactly right, but we do need to be in the ballpark and have a fairly good understanding of what we think is going to happen, and then have that happen.
And kind of on that fact, how much do the operators play into your decision? Are there certain things you look for in an operator, or certain parameters that you're looking at in that profile?
Yeah, certainly. I think the type of operator is a very important part of the overall valuation. So I think especially in today's market where we're seeing some operators struggle, the quality of operators is absolutely key. So we're looking for operators that have a healthy balance sheet. We're looking for operators that are committed to the play. We're looking for operators that don't have so much on their plate that they can't focus in a single area. We're also looking for operators that continue to demonstrate and do what they say they're going to do. So, have they put something in their press release, or have they put something in an investor presentation, or have they come out publicly and said something, and then have they executed on that? Those are the things that we really look for when we talk about operator. Certainly, the public operators provide more data, but it doesn't necessarily mean just because you're getting more data that we're going to go with a publicly traded operator than we would with a private. If we can see what we need to in terms of how healthy that operator is, what that operator's history and future development plans look like, then we're just as happy to buy underneath a private company as we are a publicly traded company.
Makes sense. And this might be getting a bit in the weeds here, but as a mineral right owner, I kind of find it overly confusing to look at the permits and have any kind of idea of when you might actually see activity based on permits or anything else that's been in that area. How do you guys go about coming up with a development schedule that would inform you guys of the likely timing for wells to come online? Is that something that you guys pay really close attention to?
We do. We use both a probabilistic and a deterministic method. So we don't figure that a permit for sure is going to say a drilling is going to happen within a certain time frame or at a certain date. But what we do say is we say, okay, we think that this is what generally the development timing would look like. And we then adjust the probabilities of when wells get drilled based on if we have permits or other filings that can give us some indications and give us some insights into, what the future plans look like and, what the operator is going to be doing. So we really kind of take that dual approach. And again, like I said, you're not going to get it right. You just try to be in the ballpark. And those things like permits and other regulatory filings really allow you to just sort of narrow your band, right? And really sort of condense down the time window in which you think that stuff's going to happen. But it doesn't allow you to pick a specific date and say, oh, yes, the rig's going to show up on this date. And now that I have that, I can get my model dialed into that kind of specificity. It really just helps you sort of narrow your range, but it doesn't really guide you down to a specific answer.
Absolutely. And I'm sure that's a constantly changing target as market evolves and everything else that goes into this.
Yeah, no, it is. And that's why we're constantly updating our valuations. We're constantly looking at areas, seeing what operators are doing, and trying to stay on top of what's happening in the basin that what we're working on and what's happening with those operators, because it does change all the time. And that's the other thing too, is, a permit is no guarantee, right? We've seen tons of permits expire. Just because somebody's filed a permit all of a sudden doesn't mean for sure that's going to get drilled. It makes it more likely than when a permit was not there. But it certainly isn't a guarantee that all of a sudden something's going to happen. And operators change their plans all the time. Well results come in that are unexpected in one area, shift their focus to another. And so, nothing's really ever set in stone. And you don't know for sure until that rig shows up on location whether or not that's going to get drilled.
And another thing that you commonly hear with mineral right owners is two people very close to each other in sections, and one received a higher offer than another. Can you talk a little bit about the types of things that go into reasons why one particular section might receive a higher offer than another section based on the timing of the operations or how soon it might happen?
Yeah, and I think that's another thing that really a lot of times mineral owners don't have a lot of insight into. And it's usually something that we have to sit down and kind of have a conversation with, again, trying to be as transparent as possible and tell them why we're valuing things in one section versus another. Typically, it's not going to be because of geology. Rocks don't know boundaries such as section lines or property lines. So more often than not, it has to do with something else external other than the rock that usually is either operator related or regulatory related. And operator related can be several things. It can be certainly whether or not there's permits filed on one section versus another that gives more insight into, we think activity is going to happen over in this area than it is in the neighboring property. Another might be just the way that the units in the land has laid out in terms of how the operator has created their drilling pattern and where they're going to drill those wells. So maybe in one section, it's very easy to see exactly how the operator is going to lay out their wells and how they're going to go about development, because that section, the way it's shaped, the way it's put together, the number of acres total, mirrors something else that we've seen. And we can say, oh, okay, yeah, we've seen that before. This is how the operator is going to go in and do that. And maybe the neighboring section is either misshapen or doesn't fit the same parameters that those other ones fit, where we all of a sudden now it provides a question mark. And you're like, well, I'm not sure exactly how the operator is going to fit the same number of wells in there because this section is shaped differently or these property boundaries are different than where we were in a neighboring section. And it can also be how the operator's gone in and developed prior to coming back and doing more development. So a lot of times what you'll see in this day and age is there'll be a lot of vertical wells in an area, and the operator's going back in now and drilling horizontal wells. And what you may have is that in one section, the way that the operator initially came in and drilled it provides for so many more locations for them to come in and drill subsequent wells. Whereas maybe the neighboring property on all other things looks the exact same. However, those initial older wells that they came in and drilled provide it so that the operator just can't fit as many wells, or they can't fit wells in the same pattern as they did in that neighboring section. And so that's usually what we see in terms of, operator differences between two sections. It could also just be the operator themselves. If you have a high quality operator in one section versus another, that could also be playing into the difference between the two sections. The other thing is regulatory. So if for some reason there's a difference in the two properties in terms of how the Oil and Gas Commission for that particular state is looking at it, or setting out development, or setting out some of the rules of engagement, that can be another thing that's influencing how one mineral owner is getting a value and a neighboring mineral owner is getting something much different.
Absolutely. And I know as a mineral right owner, once you really get into the weeds on that, it can make your head spin on all the factors that are really being considered in that in every way.
Yeah, no, that's right. I mean, there's a lot that goes into these valuations and understanding, and even not just valuations, but just if you're a mineral owner, just trying to understand what you own and what you think might happen, or how you think development might occur on your property. It's a lot to take in, and it's a lot to understand. We have an advantage because we have a whole company of folks that are focused on that, and they're professionals in that space. I think that's where mineral owners are oftentimes disadvantaged, is they don't have access to those resources. A lot of times the best information that a royalty owner has is just what they receive in the mail in terms of a check stub. And unfortunately, the operator doesn't put what their future plans are on those check stubs. The mineral owner knows, this is what I'm getting, this is what the production is, but doesn't really give them any kind of insights into the future.
Absolutely. And boy, wouldn't it be nice if they did put that on the check stub, but I can't imagine the calls they would get.
No, it would be nice for sure.
So kind of shifting gears here, this is something else we've been hearing a lot about, with everything going on right now in the industry and all the geopolitical events affecting the price of oil and natural gas. I know that a lot of our listeners are probably wondering what to expect over the next year or two. So if you don't mind, let's talk about the current state of the minerals market and see if we can kind of pick your brain there.
Sure.
So the consensus seems to be that the oil and gas industry, especially with respect to the shell operators, has weakened over the past 12 months or so. And it'd be logical to assume that the market for mineral rights has softened a bit as a result of shell operators being pressured to live within their cash flow these days. And fewer wells are being drilled. Are you feeling this? Is this what you're seeing? Or how does it look from your perspective?
No, we're definitely seeing that come through the market for sure. I think as we've seen, just like you said, operators pull back in terms of activity to really live within cash flow, which is being dictated by their investors. That's having an impact down in the mineral market as well. It takes a little bit longer for it to sort of translate to mineral owners, and for there to really be an understanding of what's happening and how that's directly impacting individuals. But we have certainly seen that transpire over the last probably 18 months or so. Especially in basins where we are, where activity has been very high. So we've been out in Oklahoma in the Eastern Anadarko Basin. We've been in the Permian, where there has been a high rig count, but even those areas that have been a hotbed of activity are feeling the effect of the slowdown here from these operators.
Absolutely. And where do you see it going in the next 12 to 24 months? If you had a crystal ball and you were looking in, what does your gut tell you?
Well, that's a really interesting question. I wish I did have a crystal ball to know exactly what's going to happen. I think one of the things that we have started to see is operators becoming more efficient. And I think that one of the things that's hard to really get a handle on, but I think we can talk about it conceptually, is, does a falling rig count necessarily translate into falling production? There certainly are some really sharp declines in all of these shale plays across the U.S. They all have very sharp declines. But does a reduction in the rig count necessarily mean we're going to see those? As operators continue to push the envelope on technologies and continue to push the envelope in terms of efficiency, not only in terms of how fast they're drilling, where they're drilling, how many hydrocarbons they can pull out of each well, going in and doing secondary recoveries to try to get additional hydrocarbons out of older wells, it really starts to become pretty hard to get your arms around exactly what a falling rig count means. I don't think it's the same as it has been in previous years. It's not quite the same as being able to draw a linear relationship and saying, oh, well, if this many rigs fall off, all of a sudden that means production's going to fall here, and now we can kind of forecast where we think prices are going to go, or what's sort of going to happen. I think the technology that we are seeing in today's oil and gas industry is really making that a little bit more murky. It's a little bit harder to understand now exactly what an impact of a falling rig count. Certainly, it helps operators on their balance sheet, but if they're able to do more with less, it doesn't necessarily mean a decline in production. So we have seen it roll through, and we have seen prices fall in those offers being made to mineral owners. We've seen mineral owners accepting lower prices. So certainly with the reduction in activity, it has had an impact. How big that impact is yet to be seen. And I don't know that it's going to be as much as we've seen in previous years. Again, with these gains in technology, it's just really hard to say.
Absolutely. And Matt and I, we've talked about many times that, the players who are the most efficient will be the ones who will survive long term.
Yeah, I think that's the name of the game, is those companies that are willing to transform, those companies that are willing to try new things, try new technologies, really push the envelope on efficiencies and technologies. Those are going to be the winners. And the folks that are going to just stay with what they thought were tried and true methods and not willing to change, those are the ones that are going to get left behind.
And on this topic, how do you feel about commodity prices? Do you see them staying stable over the next year or a year from now, being higher or lower? And if you don't mind, what are some of the reasons that you kind of see that?
Yeah, so commodity prices is not something that we typically try to forecast. I mean, I think commodity prices is something that we're really more of a recipient of. It's not something that we can influence. We do try to take a look at it and get our handle in terms of what's happening in the marketplace. And I think that you're going to continue to probably see commodity prices trade within a set range. It's hard to see anything on the horizon that moves us meaningfully out of this range. I mean, we had major geopolitical events recently with Iran and the United States and Iraq and the Middle East. I think 10 years ago, 15 years ago, that would have sent oil spiking probably $10 a barrel, and you would have seen that sustained for several months as the scenario played out and uncertainty under what was going to happen, and are there going to be more attacks? And instead, what we saw was the market responded in after-hour trading just briefly. I think it was within the span of an hour, really, that you saw a spike in oil prices. However, then oil started trading below where it was before all of that went down. And so we're in a different world. We're in a world now where those major geopolitical events don't seem to have the same impact as they used to. I think that the traders and a lot of folks within industry believe that there's enough supply out there to cover demand. They don't really see a big threat to that supply chain. And so without either some major disruption on the demand side or to see some major disruption on the supply side, I think we stay in a pretty restricted band on both oil and natural gas.
That makes sense. And I'm sure with oil and gas being such a volatile up and down, that having that consistency is not something people are complaining about.
Well, yeah, I don't know about not complaining. Certainly a lot of folks would like to see higher prices. I mean, higher commodity prices would benefit operators, and that would benefit mineral owners as well, not only in the checks they receive in terms of royalties, but also allows us as mineral acquisition companies to offer more. And right now we can't. We don't try to guess what we think that the oil price is going to be in the future. We use the current strip pricing on NYMEX as our go-to, and we don't try to forecast that into our valuations. But I think certainly some price help, I think you'd see all boats rise a little.
That makes a lot of sense. You mentioned things getting a little bit skinnier in the past 12 to 18 months. Have you seen a lot of the middlemen in the industry get pushed out of the market just because that margin isn't there like it used to be? I mean, so if you're going to an individual mineral owner, are you still seeing some competition from those that are looking for kind of a short-term hold and then flipping it to others, or is that activity level decreased in what you're seeing?
No, I think you're touching on a really important trend in the mineral market, and actually one that we've been really pleased in seeing. And it is that a lot of the middlemen are getting squeezed out of the market and being pushed out. For a while there, we saw sort of a fervor around minerals in which you had these middlemen that would buy for a quick flip, trying to flip to, either another flipper or to an end user. And we really saw this explosion in that middlemen market as people were trying to buy things at one price and quickly turn them around and sell them at a higher price and capture that spread. What we've seen now in the decreasing price in the mineral markets, at least where we're active, is that some of those guys got stung and they paid a high price for mineral assets. And then as prices fell, they weren't able to unload them. And those middlemen just aren't set up and don't have the capital to be able to hold those assets long term. They need that constant generation of income coming in the door, of capturing that spread from buying it at one price and turning around quickly and selling it at another. And so a lot of those guys and gals have left the space out of that sort of middleman type bracket. And I think that's been better for everybody because it allows mineral owners to have more direct access to end users, and it creates more efficiency in the market of just bringing the sellers directly to the end users. So it's something we've been pleased to see, but it certainly has something that's been impactful and a trend we've seen in the mineral market over the last few months.
Yeah, that's interesting to hear. And I imagine it's going to take some time for mineral owners to get their arms around that. Because I know just anecdotally talking to folks where they get a little gun shy. They get a bunch of unsolicited offers in the mail, and it's hard to know without doing evaluation and getting help. And that's what we always advocate for. But, if you look at an offer, it's, in the past, it was usually a low offer. And to the extent that people don't shop their minerals around and get, in front of an end buyer, then there's a good chance they'll get taken advantage of. So I agree with your perspective. And then I think it's probably good for the landowner in the long term because they're going to get more value.
Yeah, I mean they get more value, and I think they get more certainty of close. I mean, a lot of the ways that these middlemen operate would be they wouldn't even have the money to be able to pay the mineral owner, and so what they would do is go out, lock up the mineral owner on a extended contract, typically 45 or 60 days, and then they use that time, that 45 to 60 days, to try to go out and find a buyer of what now they have under contract. And they need that. If they don't get a buyer, then that's when you saw a lot of instances where mineral owners were just left standing at the altar and deals failed to close. I think that really puts a bad spin on the mineral market. It makes mineral owners distrust those folks that are willing to go out and pay value for their minerals. It doesn't take many times of being told that you're going to have a deal, have something even under contract, and then you find out the other party walks, that's going to leave a bad taste in your mouth, and it's going to make you very distrustful, and it's going to make you very wary of doing business. And we get that. We understand that. It would make me very wary of doing business. And so certainly, like you, I would advocate that people do as much homework as they can when they get an offer in the mail or they get a phone call from somebody. Not just take them at their word that they're going to be able to deliver on what they say they're going to be able to do. Do a little bit of research. But to the extent we've seen some of those guys pushed out, hopefully some of that risk has started to leave the market as well. And again, as we connect mineral owners more directly with end users, that goes away. And hopefully we can bring back some of the trust. We can bring back some of the integrity into the space. And really make it a pretty efficient market where people feel confident that they can go out if they want to sell and be able to sell and know that they're going to be able to transact, that the money will show up on closing, that there isn't going to be any kind of shenanigans, and that they can have confidence in that market. And I don't think that was always there. I think that we're getting back to that. We still have some more work to do. But that's where we want to end up. We want to be in that efficient marketplace where there is trust and you can see people transacting efficiently between seller and buyer.
Yeah, I agree with that. Okay, let's shift gears a little bit to another topic around leasing. And you guys, I imagine, with as much acreage as you have, you're continually looking at leasing anything that opens up, or if you have some open tracks that operators approach you and look to lease. What is your thought process in leasing? All things being equal, you always hear that a tract that's leased at for example, a 25% royalty is worth twice as much as if it were leased at a 12.5% royalty. And so you always hear the advice to go for the highest royalty rate possible. Is this always the best thing to do? I mean, is there a case to be made that by going with a slightly lower royalty rate, you improve the economics for the operator, and then they might actually be more likely to drill on your acreage first?
Yeah, I think that argument certainly is out there. I think it really sort of depends on how big the tract is and where the tract is located. So if you have a small tract, let's say 10 acres in a section, unfortunately, your 10 acres just isn't enough to really move the economics for the operator. So if you take a higher royalty rate, it's not going to dissuade them from drilling that tract. They're going to look at what's the overall average royalty rate in that entire tract. Now, if you own a larger piece of land, so let's say you own something meaningful like 320 acres or 640 acres, that's a different story. That's where when you sit down and have that lease negotiation, you are directly impacting then the economics of the operator. And there certainly is a case to be made that a lower royalty will entice development to come to your property sooner. Now, it's never a guarantee, but it certainly is something that the operator is going to pay very close attention to. And so, it always sort of comes down to, what's your exact situation? You're always going to be offered bonus plus royalty. And in those instances where you're going to take, less royalty, if you have that view that you want to try to entice the operator and you're willing to take a lower royalty rate, you should demand a higher bonus payment up front. That should be the trade-off. Similarly, if you're going to take a higher royalty rate, operators typically are going to pay you a lower bonus for giving up some of that royalty back to the owner. So those are the trade-offs, and those are the considerations you really need to think about as you sit down into those leasing negotiations.
Yeah, and I think, like you said, really depends on the individual situation. I mean, I can see a scenario where, like you and I were talking yesterday, where if you were to be in an area where you don't expect drilling to happen right away, you think they're maybe just trying to put the stake in the ground, but really when you look at the rest of the information, you don't feel bullish that they're actually going to drill. Does it make sense in some cases to maybe go for as short a term as possible in a lease and try to get as much bonus money up front and a lower royalty, to your earlier point about the trade-off between bonus and royalty rate? Just get that maximum lease bonus and then hope to release those minerals again before they actually go and drill a well. Is that something you guys think about as well?
Yeah, no, definitely. I think the operator plays a very key part of that decision making process in terms of who is the operator. If you go do a little bit of research, and if the operator is a large established operator, they've been out in the area where you own your minerals, they've been out there drilling, you have a good sense that they're going to continue to be out there drilling, then yeah, you probably are going to want to negotiate things and understand that they're going to come drill on you within a relatively good time window, and so you kind of take that approach. I think other operators that are less established, or operators that don't have a strong track record, or you think might be just trying to tie up a bunch of land, and they're going to try to flip that onto somebody else, or they're just trying to lock up a bunch of land now, and they're going to shelve this area, or they're going to come back and drill this at some point in the future. That definitely is an instance where you want to try to take advantage of demanding for shorter term, bigger bonus, knowing that that term probably will most likely come up without them having drilled on your property. And then you can release it again and get back into those negotiations and try to get the bonus and royalty again. And maybe in the future, the picture changes and you're able to negotiate something different. But I think that definitely taking a look at the operator and understanding that operator weighs into that decision process. And there certainly is a case to be made for a shorter term on the lease and a really high bonus in those instances where you have a situation where you don't think that the operator is going to get in there and drill it right away.
Yeah, that makes a lot of sense. So let's wrap up with a discussion on some other ways that mineral owners can help themselves when it comes to working with mineral buyers. And what are some of the things that a mineral owner can do to maximize value from their minerals should they ever sell? I mean, some of the things that they need to be doing in advance before they start to go and market their property or before they approach a buyer.
Yeah, I think the number one thing is having a good understanding of what they own. We've had so many instances where mineral owners think they own a certain number of acres, and when we get into the due diligence process, when we start running title, looking at the background, it turns out that they own something different than they had originally thought. And a lot of times that results in disappointment because many times those revisions go in the wrong direction for the mineral owner. Those are, they don't own as much as they thought, and so their offer price goes down. So knowing up front what you own is very key. And the way that you can establish that, you can have a good understanding that you want to have good records of the check stubs that you've collected over a period of time, which are going to show your net revenue interest, your NRI, which is something that all mineral buyers are going to key in on right away. I think also any division orders that you've received from the operator will say on there what the operator thinks that you own. Now, sometimes you may have a differing view, and there's ways you can go through things either legally or work with the operator to make adjustments if they have it wrong. They don't always get it right. But for the most part, the operator most times is going to have a pretty good handle on what you own. And so getting the division order from the operator that spells that out is also really key. And of course, you can always go to the courthouse, and it really doesn't take much time at all to go to the courthouse, search under your name or whoever's name that the mineral rights are in, and just pull up whatever relevant documents show up on the computer, pull those down, take a look at deeds, those types of documents, and really have a good understanding of what you own. I think that's the number one biggest thing. I think the other thing that mineral owners can do to sort of prepare and go meet with a potential buyer is also just do a little bit of research in terms of what's been happening in your area. Talk to your neighbors, talk to people you know. I mean, we did talk about why people's offers are different from one section to the other, but that's good background information to have. You want to know what offers are being made to other people in the surrounding area. Like I said before, the rock doesn't know any difference on boundary. It doesn't know that your friend owns one side of a line and you own the other. I mean, the rock just permeates down underneath the subsurface. It doesn't recognize boundaries. And so it's really related usually to something else, as we talked about before. But having that background information in terms of what other people are doing is also key. And then you need to research the company that's making you the offer, or research the company that you potentially are going to be working with, and understand whether or not they have a good track record, whether or not they can be able to do what they say they can do, and what's their reputation like, what's their own capabilities. Do they have the money to pay you today, or are these one of these companies that they're just trying to lock you up under contract, and then they've got to go out and try to find the money. So those are all things that mineral owners should really investigate and look into before they get out there and really start working with somebody and sign a contract and head down that path of selling.
Yeah, those are all really good tips. And obviously, before you sign anything, you want to have an attorney review it, if at all possible. That's always best practice as well. One of the things that I hear about is people getting something in their mind about what something's worth and maybe being stuck in that mindset. There are some things that mineral owners should definitely not do that would put them at a disadvantage when trying to get top dollar for their property. Obviously, you want to negotiate, and that's part of it, but there's a give and take, right? So what are some other things that you've seen where a mineral owner maybe has shot themselves in the foot?
Yeah, I think one of the things is we don't see mineral owners sometimes ask enough questions, and mineral owners really should ask a lot of questions around how somebody's coming up with the value, even if, like you said, they have a number in their head that they think they should be getting, and offers are coming in lower than that. Rather than just saying, well, I'm not interested in talking to you any further. It's worth them exploring and saying, well, you need to explain to me why your number is where it is. How many wells did you assume are going to be drilled, or did you account for all the wells on my property, or did you account for future development, or how many zones are you valuing on my property? Those are all good questions, and many others. And so I would say mineral owners shouldn't be afraid to ask a lot of questions of somebody who's bringing them an offer and try to get as much understanding as they can. And that also really helps in comparing offers as well. It really empowers the mineral owner, especially in situations where they're getting multiple offers from people. If they have a good understanding of one, they can go back to another offer and say, well, this guy over here is valuing me for 3 zones. He's valuing my 3 current wells. And he says that, there's going to be 4 future wells. And so, in my mind, that puts the price here. What's your offer entail? And, if that guy comes back with something different, that certainly starts a dialogue or can certainly empower mineral owners. They're not probably going to be able to go out and do the geology and the engineering themselves, but certainly they should ask those detailed questions of those people that do have those things at their disposal to try to get as much of that information as.
That's really good advice. And, another thing that a mineral owner can do is actually go and hire somebody to do the valuation for them. If you have a significant mineral estate, definitely worth having somebody provide an independent valuation where they can tell you, here's the assumptions that went into this number. And then to Will's point, you can always use that to say, well, I think that, here's a possible development scenario. Maybe instead of X number of wells, I think it's X plus 4, and here's why. Is that something you could value the property based on that assumption? Or why do you think that it's going to be a lower well count overall? But just in general, having an idea of some of the assumptions that go into it before you even ask those questions. But that's a really good point that I think most buyers too, if they're really wanting to be transparent and in it for the long haul, are going to be willing to answer those types of questions. So I think that's a really good point.
Yeah. And I think, to your point, a consultant helps provide the language for that dialogue, because if a mineral owner just has a number in their head because that's just a number that they came up with, it makes it really hard for us to have a dialogue around the number that we came up with. I mean, certainly I can show you the things that we use to put in that, but if there's no reason or basis for the number that they have in their minds, then it becomes just sort of a one-way conversation. A consultant certainly can help provide a conduit and a language and a dialogue now between the seller and the buyer, because the seller can say, well, this is the value that I think it's worth, and here's why. And then when a buyer says, well, and here's how we're coming up with a value, all of a sudden now you can have a pretty good exchange. Without that, again, it really sort of is a one-way conversation of just information being provided to one side and the other side just saying, well, here's my number and this is what I just think because that's what I think.
All right. Well, I know you're a busy guy, so I want to wrap things up. But before I do, anything else that we missed that you want to mention before we close out?
Nothing in particular. I think we've covered a lot of ground. I think there's certainly some topics here we could have spent a lot more time on as well. But, if people want to find out more about us, it's easy to do. You just go out onto the web. We're longpointminerals.com is where you can find us on the internet. And then if you actually want to see us in person, we'll be in Houston at the NAPE Summit, February 6th and 7th. We'll have a booth out there. We're really excited to be a sponsor this year. Stop by and see us in Houston, February 6th and 7th at the NAPE Summit.
Very good. Well, thank you much, Will. I appreciate your time. And thanks again for coming on the show. And if somebody has a question that they can get a hold of you after they listen to this?
Yeah, certainly. There's a way to contact us through our website, as I mentioned, longpointminerals.com. Or you can just dial into our main number, 303-290-0990, or feel free to send me an email. And my email address is just wcullen@longpointminerals.com.
Great. Well, thanks again, and we'll talk to you soon.
Thanks, Matt.
Thanks so much for listening to the Mineral Rights Podcast with your host, Matt Sands. Don't forget to subscribe and share at mineralrightspodcast.com. The Mineral Rights Podcast should not be construed as investment, legal, or tax advice. All information is believed to be from reliable sources. However, we make no representation as to its completeness or accuracy.